So we're going to talk about construction loans today. Dad's had a couple videos on his channel that have gotten quite a bit of engagement on construction loans, and so we're just going to keep people on with the topic, engage with some of the questions we've gotten on there. So Dan, I'll let you introduce just generally kind of construction loans in general. Let's assume most people coming into this are familiar with the mortgage process that for traditional already built homes.
Yeah.
Are construction loans considered conventional? Can they be?
Yeah, I mean, it's conventional, just as typically versus government.
Yeah.
I mean, a
But
construction loan can be a VA, construction loan.
But they
a
can be
VA,
conventional.
or can be conventional, and like most loans, most of them are gonna be conventional.
Yeah.
There are VA construction loans.
So can you start by just differentiating what, broadly speaking, so someone's coming into this, they know they want to build their own house, but that's about all they know, and they want to get a loan to do so, and they've heard about construction loans, specifically for construction loans. Broadly speaking, what are construction loans and how are they different from traditional mortgages?
Yeah, so construction loan is, when you are financing a home through the construction, from the ground up through construction phase. Of course, you don't, and a lender is not going to say, here's $500,000, we've approved you, you qualify for $500,000, we know that's how much you want to build this house, here's your $500,000, go build a house and send us a picture when you're done, sort of a thing. Of course, they won't do that. So the process involves, you first of all, you're appraising a concept. You're not appraising an actual home that's already built, that's on a particular lot. So you're appraising a concept, and the lender will take the detailed cost breakdown, the actual contract that you have with the builder, the description of materials, and they'll take all that and the land itself, the location that's going to be, and they'll do an appraisal as if that were built, and so they'll take that and they'll go, okay, and they have appraisers that do this, and they'll look at it and say, okay, if you build this house according to these specs, then it will be worth this. On this lot, it will be worth this. And that's what it kind of establishes the value for purposes of doing the construction loan. And then, so, they're going to approve that. They're going to approve the builder. There's three different approvals involved in a construction loan. Whereas, when you buy a house, you're getting an appraisal on the house, and they're approving you as a borrower, right? They're taking out your debt to income ratios, your credit scores, your job history, where your money's coming from to do the deal, all the normal stuff that most people are pretty familiar with when they come to do a construction loan, because it's usually not your first house. But a construction loan has two more elements. They still do all of that with the borrower, but then you have to approve the project, and that's much more involved than just sending an appraiser out to look at existing properties we've just discussed. But then they also have to approve the builder, because they're generally not going to want to finance a home depending on a builder who's doing his first whole project. They're going to want to make sure they have someone that's got experience. They've been in the business for, let's say, 3 years or more. They've got experience doing this kind of project. They have subs that can get references from, and all the normal bonds and whatnot.
So right there, I think, I don't know this, but I think people sometimes come into the process of getting a construction loan with the idea of getting money to do it themselves. Is that, that sounds like it's not an option with what you're talking about. Is that ever an option? I know there's a difference between builder, owner, owner, builder. Are you talking about one of those here? How could that be involved? And what changes if that's kind of the idea?
Your options narrow substantially if you want to be either a builder owner or an owner builder. The distinction there is, can be somewhat of a subtle one. An owner builder is just someone, let's take me, I'm a mortgage broker, and I go, I want to build my own house. I know how to do this. I used to work in construction. I didn't really, but let's say I did, and I know how to build this house, and I'm just smart enough to project manage it, and I've got people that I can rely on, and I want to do it myself. So I'm an owner builder, but I'm not in the trades. I don't have experience building at all. A builder owner is just someone who says, no, I'm actually a contractor. I build houses for a living, and now I'm going to build one for myself. So an owner builder, not in the trades, no real experience, very hard to get. Now, I recently had a comment on my YouTube channel. Someone who said, hey, don't be too discouraging about that, because I did that. And so I asked him to elaborate on that, and you can go in the comments and see that. And he gave a lot of kind of background information about what happened. But basically, they had a situation where their builder bailed on him partway through the process, and he ended up having to do it on his own. And the bank kind of had to take it. That was just how it worked out. And they had a lot of down payment, and he had experience, and he got it done. And then he went and did it again. But I think maybe with the same bank, because he demonstrated he could do it before. But that's going to be really rare. So don't really plan on being able to do that on your own. But then, don't despair of that. I think you got a case to make. Go make it. And that's the other thing I would back up and say, just about construction loans in general. For non-construction loans, just you're buying an existing home, even if it's new construction. A builder built it, now it's ready to sell, and you go buy it. You're still just buying a home that's already built and ready to go. For buying those, the vast majority of us are going to go into Fannie or Freddie loans, because those are the most generous underwriting. Those are generally the most generous pricing, the most reliable mortgages. And so we all get in that same box. 90% of us are in that same box of Fannie and Freddie. So guidelines and everything is virtually the same. Fannie and Freddie have about a 95% overlap between them in terms of similarities in underwriting and everything. So there's just not a lot of variety ultimately. But construction is wholly different. These are a lot of little community banks, local banks. Big banks will do them too, but they're just far less the same. They're much more variable. They're much more niche in terms of they can do a lot more with whatever they want to do, whatever their appetite and their skills will allow. So don't despair and not call around. Call your local banks and say, this is what I want to do. I want to build it on my own. Will you do that? And you might find somebody to do that.
Let's see if we can just rapid fire a few just kind of general concept questions, kind of yes or no's. Are they, it doesn't have to be yes or no, but pretty quick. Are they, how do they compare on pricing to, let's not say pricing, let's say the interest rate, the interest rate that you're going to get on a construction loan? How does that compare to a conventional or traditional?
Just almost invariably, your interest rate is going to be higher than if you're buying a ready-built home. And for a couple of reasons. One, it's a niche product, so not everybody does it, right? So fewer providers in that sphere. But the other thing is really much more fundamental, just to the nature of the mortgage market itself, is lenders typically, they're not typically lending to you and then holding that for 30 years, holding on to that, because they've run out of money. If they just kept lending on mortgages and never sold those, transferred them to another entity, get their money replaced so they can lend it to someone else, they've run out of money. So some of them do service, but many of them don't. And the value of the mortgage depends on the interest rate relative to what the market is. And so right now, if the prevailing market is 7% for a mortgage, and so I give you a mortgage, I agree to do your construction loan for 7%. Well, I can't deliver that mortgage to the secondary market until 9 months from now, right? It's going to take you 6, 7, 8 months to build your house. And I can't sell that mortgage during that time. And so I can't deliver that mortgage until 9 months down the road. And that 9 months represents risk for the lender. The lender is saying, look, I've committed to you 30 year, for 7% for 30 years. And I don't want to make a comment about that. But now it's 9 months later, and now I'm delivering that loan to the secondary market. And maybe the rates have gone, let's pretend this was 2021 and going into 2022, and everybody thought rates were going to go down. They shot up rapidly, as we all know. Imagine construction lenders who gave fixed rate mortgages, and during that 9 months saw rates go up 3%, 4%, and they committed to that. So that's a big loss for them. So as a result, they're going to build in a premium into the rate that they'll offer you. Now, taking a step backwards, many construction lenders won't do a fixed rate, won't give you a fixed rate mortgage going into the construction term. Most of them will give you a fixed rate option at the end of that construction term, but they won't lock in your rate for that very reason that we just talked about, because they can't take that risk. Now, there are lenders out there who will lock you in at the very beginning of the process, good lenders out there, good options out there. And, wherever you are in your market, go to mortgagematchup.com. And you will find great local brokers who have access to good products, and they should give you a fixed rate option. And then there's adjustable rates as well, if that's your thing, but.
So just, let's get into the process then there. When you go to, let's say you come to Cleveland Street and you want to get a construction loan, and I guess let's just start there. What will the process look like? When do I know if I'm approved? So you talked about what needs to be approved. When do I just get an approval up front, and then do I get all the money up front for the job? What is the process of getting the loan? Locking your interest rate? Do you lock it up front? Do you lock it later? What does the process look like?
Yeah. So taking a little step back, one of the things you just needs to be addressed when you are initially thinking about building on your own is land. You can't build without land. And land financing, if you don't have the land and you're planning on acquiring the land with the construction loan, that can be tricky. It's possible to do that, but understanding that you don't fund a construction loan until you've got the builder approved, the borrower approved, and the project approved. And that means you need contracts, permits. You can't fund that construction loan until you have permits, all of that. And so if you're using that construction loan to finance the land, you wouldn't, you'd have to invest a lot in getting contracts, permits, and all of that before you actually own the land. And there's a big risk there. So it's possible, but most people are going to have land. Maybe they finance it separately. They put money down, they finance it separately with the bank. And then the first construction draw pays off that land loan and then continues on. Now, to your point, when do you know you're approved? And so, you know you're approved when all three of those elements are completed and approved. So your person, the borrower has been approved, so the bank is under it. That's the easiest thing, right? That's pretty simple. We all do that pretty quickly. That won't take very long. One little element there, different lenders, construction lenders will treat your current residence differently. Now, if you're renting, it's a no-brainer. They'll ignore the rent because they know you're going to be out of that lease and you're going to move into your new home when you build it. This all assumes you're going to occupy the property you're building. That's not always the case. You can build an investment property. But if you own a home and you're departing from that home, that can be a little tricky from a financing standpoint. If you still own that during the construction period, one way banks get around that is they'll get a rent value letter, or market rent letter from a realtor or somebody that says, here's what the rental value of your current home would be to kind of offset that payment. Some will just ignore it outright, knowing that you're going to sell it with a letter from you stating what you're going to do. But just be aware of that. So you get approved as a borrower, and then your builder gets approved, and your builder, these aren't super simple process. I mean, builders are very familiar with it. It's not like it'll hit them by surprise and maybe they'll grumble a little bit, but they have to provide their sub list. They have to provide their credit report. They have to provide their references. They have to provide history of jobs done. There's all kinds of things that go into the process. Their bonds, licenses, all of that good stuff. So your builder gets approved, the borrower gets approved, and then the project gets approved. Then you give them you have to have a contract with your builder, and you have to have a detailed cost breakdown, and you give that to the lender, and they appraise that project. And then when all three of those things are done, then the lender says, okay, this deal is approved. We're ready to go. We're ready to start dispersing on this. And a construction loan is always, a staged disbursement. You're dispersing, and typically what's going to happen is the very first disbursement is going to pay off any underlying liens. And so if you have land that let's say it's worth $200,000 and you borrowed $100,000 to buy it, that first draw is gonna pay off that $100,000 underlying lien in the land, because they won't give you a loan unless they're in first lien position. So we're gonna pay off that lien. Now, the other thing to be aware of on a construction loan is, if, most people aren't going into a construction loan, some people do, with the equity in the land, they don't need to bring any money to the table. They're gonna finance 100% of what they need to pay to build this house, and it's all gonna be in the financing. They don't have to put a penny in more. But a lot of people are bringing money to the table, or they plan to say, oh, I don't need to borrow the whole thing. I'm gonna put 100,000 of my own into this deal in addition to my land equity or whatever. Just understand that you have to put that money in right at closing. Right at that first draw, right when your loan closes, you have to give the lender that money. They're not going to say, look, we're going to spend our money first, and then 8 months down the road or 7 months down the road, however far they get, when they kind of spend all their money, then say, okay, now we want you to put your 100,000 in. They're going to require that up front, and that's for obvious reasons, right? Because they need to make sure that that money is safe and secure, not being spent somewhere else, and is available to the deal. So you get approved, the loan gets dispersed, they pay off the lien, against the property. You put your money into the deal, and then your contractor starts building. Your contractor starts building, and the lender will send an inspector out every month to review progress. Typically, they're only going to pay out based upon items that are completed. So even if let's say that you're going to go into framing next, they go out the first month's draw, and the foundation's fully poured and ready to go, and they go and look at that and okay, foundation's poured. Here's the detailed cost breakdown. That was 125 for the 100 for the foundation, whatever that number is. Okay, we see that it's done. Here's $100,000, and sometimes they'll issue the check to you as the borrower. Sometimes they'll issue it to the builder. A lot of times they'll issue it requiring a joint signature from both of you, both agreeing. But they'll issue that money. Now, let's say, in addition, the builder had delivered all the sticks to the property. That's for the framing. That's the next phase. And all the sticks are already delivered. They're sitting there, and the builder's got to pay for those at some point. But typically, you're not going to get paid for those because they're just delivered to the site. They have to be actually up and framed in. That work has to be done. And so that's kind of how that part would work. But you just go through the process, and you do that every month. Every month, the lender sends out an inspector. They review it, and you get to the end of the project, and they go, okay, it's all done. You get the certificate of occupancy. Different jurisdictions have different names for that, but most jurisdictions have some form of coming in, reviewing the project, and saying, yeah, this is all ready to be occupied. It's we're signing off on the final permit, is what they call it here, I think. And then typically these loans, then there are still some loans out there that are just construction loans, and then you got to refinance. You shouldn't have to do that kind of a loan. There's a lot of one-step construction loans. When I got started, ththese were kind of an innovation. It used to be most everybody had to do 2 loans to build. But now most everybody has access to just a one-step construction loan where it automatically then rolls into the 30-year fixed rate amortization period. Now, if you have one of those lenders who would not fix your interest rate in, then you're going to have to fix that interest rate in at that point in time, and then roll it into your 30-year financing.
If someone knows they want to go with a construction loan to build, but they don't have the property yet, how do they think through? You mentioned you may be able to get the land with your construction loan. How do you think through whether pursuing that option? Are there better options out there?
Yeah, I mean, I think there are construction loans that will build for 5% total. Right into the deal. Owner-occupied construction loans, you put 5% down. VA may be 100%, but for conventional, 5% down. But most lot loans are going to require a much higher percentage down payment. So I mean, I think as a practical matter, most people are going to want to finance that construction loan. I mean, that land prior to coming into the construction loan, because if you're relying on financing it with the construction loan, then you have to have a very patient seller, right? Because this is a long, this is a fairly lengthy process. You're acquiring the land, you go into contract on the land, and then you start working on your permits and your contracts. And maybe if you've just got it all figured out and buttoned up really tightly, that won't be such a big issue, and they're willing to wait, and you're willing to invest the money into all the things that you need to invest in, the architectural plans, the contracts, the permits, all of that before you technically become owner of that land, if you're willing to take that risk. So I think there's certain circumstances where that could work, and land sellers are generally going to be more patient
Not the
than
same as buying a house.
than buying a house. Because anybody buying land, typically there's some feasibility period involved and making sure that they can do what they want to do with the land. So it's not impossible.
Yeah.
But generally, I would recommend just call your local banks, and again, we're talking about 5% down on a construction project. But 30% down, let's say, there's people who do less than that on land, but that's not uncommon. 30% is required. That's only in the land. So if you're having to put 30% down on the land, and the land's 100,000, that's 30,000. But if you're going to build another $400,000 project on top of that, then you're all in at 500. Okay, but 5% of that's only 25. So you really are, that matches up okay. That can work in that situation where then your land equity becomes your down payment for your construction loan. You're not having to put a whole lot more cash into it. So I would just say, buying the land, make sure you think through the cash. Look at getting a home equity line of credit. And I would recommend that to anybody. Get a home equity line of credit. Find one that's free to get. Most communities should, many communities should have access to a free home equity line of credit. Get one. This assumes you have an existing home that you're departing, or maybe a hold on to it for rental. But get that, because that's just a good liquidity vehicle, right? You can use that to buy your land, especially if you're just going to sell it and using that equity anyway. That's just taking an advance on that equity by taking a home equity line of credit, taking some of that equity out of the property and using it for the purchase side. So I would say, that's another way to finance a land payment, or at least a land down payment, is through that.
Yeah. That's helpful. So real quick, I want to read some of the comments, some of the questions here on the video.
People are out there watching?
Well, we do have 2 viewers right now on that one. But comments on
whoever you are, thank you.
On
call your friends.
Comments on the original construction video with questions. But real quick,
I see. Okay.
That someone has the land.
Okay.
Someone has the land. They want to build on it. They own the land. Okay, let's say 2 scenarios. One, they own the land free and clear, and then one scenario they have still somewhat of a loan on the land. Is construction loan, and they want to build. Is construction loan always the best option, or are there other things to consider as far as getting financing to build your home? Yeah,
unless you got a rich family or a friend. I mean, I don't know where else that money would come from.
There's no other like, would it be better? Let's say you own land, but you're currently in a house. You could finance the building of the land or the building of the house with a HELOC from your house.
Oh, I see.
Let's say something like that. I don't know what other options are out there.
I think, for most people, the HELOC is not going to cover everything that you need on the existing. I mean, if you could do it with a HELOC and you plan to liquidate that property that you're putting a HELOC on anyway, I wouldn't want to have $500,000 on the HELOC for a very long
You're going to sell the house you're living in to live in the house you're building.
And yes, I mean, that's a good point. I mean, there are people who, there are banks who will go up to $500,000 on a home equity line of credit. So if you have enough equity, and you plan to sell anyway, the reason I say if you plan to sell anyway, because I wouldn't want to have a $500,000 debt that was on a revolving line of credit that adjusts monthly. That as soon as rates go up, that's too volatile for most people, I think, to have long-term money on a HELOC like that. But if you're going to sell that property anyway, and you've got enough equity to fully cover your construction loan, then I would say, definitely tap into that, because that, the problem is you can't just get a cash out refinance, take $500,000 out for a couple of reasons. One is that in order to do a cash out refinance on a conventional loan, you have to state in the deed of trust that, you're signing a statement that says, it is my intent to occupy this property as my primary residence for at least a year. And maybe that's possible in a long-term construction project, but that gets a little tricky, right? And then the other problem with it, maybe more fundamentally, is on a just a conventional refinance, all that money comes out right away. So you've got 500,000 that you've just got to park, in probably some very low interest paying instrument, savings account, and it's not earning you anything, but you start paying 7% on it right away. So so whereas a HELOC, you just draw month by month and you only pay interest on what you're drawing. Mm-hmm. And HELOCs are typically cheap to get. And so, so HELOC could be an option, but it's going to be the rare situation where that, but yeah, that could be a great one if you find yourself.
Yeah. So not any other real competitors out there.
Yeah. And a HELOC, it was implied, but the HELOC agreements, I wanted to say uniform there. I haven't seen a full, my sample size is pretty small, but I've seen many around and they're all very similar. None of them have a clause that states it's your intention to occupy that residence, occupy that home as your primary residence. But I don't recommend volunteering that you're not going to if they don't ask. There's no requirement that you volunteer any information. You answer everything truthfully, and honestly in all of your application, all your lending, you should do that. But you don't have to volunteer things that they don't answer. And I've worked with many local banks here, and I've gone back to them and just saying, hey, I want to make sure this is okay, because sometimes your frontline loan officers get queasy when my borrowers go in there and then they volunteer, oh yeah, we're going to buy this house, this is what we're doing with this money, and then they start to want to go, oh well, we can't really do this HELOC if you're just going to move out of it in a little while. And we've fought that through management, and they said, no, really you can, and there's nothing wrong with that. So don't volunteer stuff you don't have to. Be honest about everything that you do disclose. And that could be a good option, but you don't have to state that you plan to stay there for a year in most of the agreements I've seen.
Yeah. Okay, I want to read just a few questions from the video. One person asked, is it better to pay off your land or include it into the construction loan? So you have a debt left on your land as you're coming in, pay it off before with cash that you have, or put down payment? Yeah. How does that work?
Yeah, it depends. I mean, if your construction project is months and months away and you've got the cash to pay off the debt, you're sitting on a land loan that's 8% and you're paying 8% on 100,000 for several months. Maybe it's best, but I would definitely make sure you consult with your loan officer on the construction loan ahead of time, because you want to make sure. Usually I would say keep cash. Cash is really important. You're going to have to pay off that construction loan. I mean, that land loan. That land loan will not survive the closing of the construction loan. It's going to be paid off at least by that point. And so the question is, do I pay it off now, use my cash now, or do I wait and let the lender pay it off at closing? And I would say, just from a practical standpoint, it just depends on how much time. I mean, if you're coming right up to the closing, you got a month to go and you're supposed to close on your construction loan, I wouldn't pay off the land myself, because then it's harder to verify, that's all the lien's free. Whereas giving the money to escrow and saying you paid off, clear the lien, that's all natural part of the process of doing construction loan, paying the lien off and verifying that to the new lender. So I wouldn't, I would just go ahead and let the lender do that. Mm-hmm. It's going to be cash out of your pocket either way. Mm-hmm. But I would kind of hold on to that cash and until I have real clear understanding with my lender. Because
you're saying paying it off ahead of time could interfere with, paying it off ahead of time could make the approval process for the construction loan a little messier.
Yeah, I mean, for the most part, you pay it off, you'll get verification proof of it. But just, it's a lot harder for you to prove that you've paid off a loan, a lien, to a lender versus saying, here, escrow, here's 100,000, close this loan and clear this lien. Mm-hmm. That's a natural process that happens all the time with lenders. And so they know how to do that. It all happens that one day and you have to do nothing other than here's the check. Mm-hmm. Whereas if you pay off the lien yourself, you have to call, get a payoff balance, send them the money, get proof of lien clearance, give that back to the lender. It's just a whole messier process.
Yeah. Chris Klein, you want to read that question?
What's your take on one-time close versus two-time close? Thanks, Chris, for that question. Well, I would have to see the details, but I think almost universally one-time close is going to be preferred. Because a two-time close basically means you have two separate loans. And so, two escrows, and maybe even two different lenders. I don't know kind of what your options are, but if your existing lender is only offering you a two-time close, I would definitely shop around and, like I said earlier, go to mortgagematchup.com and find somebody who does construction lending, one-time close construction, and then just do the comparisons. Of course, you want to know the details. Ultimately, you want to know optimize for the long run, right? You're optimizing for a 30-year mortgage, not for this 12-month construction. And so, if you did a one-time close, but it meant you're getting an 8% instead of a 6%, on that one-time loan, then that's probably not as good as a two-time close that's going to give you 6% and guaranteeing that up front. But I imagine a two-time close also is far less likely to fix in your interest rate, at the very front end of the deal. And so you're going to be subject to whatever's happening in the market.
What kind of costs are included? What expenses can you include on your construction loan? What range? Obviously,
yeah,
we can't get a detail exhaustively.
So when you're saying what kind can you include, so part of that has to do with how construction loans are underwritten. They underwrite. Not, typically when you just buy a ready-made home, it's loan to value, right? It's just whatever. If the house costs 100 and you want to borrow 80, you have an 80% loan to value. Whereas construction, they look at loan to cost and then they look at cost and value and say whichever is lower, that's what we're going to use. So what's included in loan to cost is essentially all the same things that you can include in your construction loan, but that includes all your lending costs. So any of your mortgage costs are included in that loan to cost calculation. So your appraisal, title, escrow, credit reports, loan origination costs, discount points, all that can be included in your cost basis of the house for the loan to cost calculation, and also in the financing part. And then you have all your soft costs for your plans and specs and your permits and any of that kind of stuff goes into that cost as well. And then your prepaids. Prepaids can be tricky. Just be careful. Be very clear with whoever your lender is. Be careful about doing too much ahead of time. Let's say you've just got a deal and you've got a contractor. You've got your foundation contractor, and you've been waiting to get this loan approved, and it's taken a long time to get approved. And you're going to lose your contractor. Now they got to move on to another job, so you either got to get them going now or you got to lose them. Sometimes that happens. Just be very clear with your bank about how do I document this so I get this money back. So I make sure that if I have to put money in ahead of time, that's going to be counted and I can get it back, because there's very specific requirements about how you document these prepaid things. There's also some tricky things about contractors' liens that can occur before the loan is issued. Mechanics liens, contractors liens, there are issues that banks will have with that. But they can be included as well. Prepaids can be. Just be careful about it.
Yeah. Okay, I'll read one more question and we can start to wrap up. As far as when you start making payments, this person asks, do you have to start paying on a construction loan as soon as it closes, or is it when the construction loan is done?
Yeah.
When the construction is done.
Yeah. So, this one I got a comment on one of my videos 2 days ago about someone who said the lender was requiring principal payments during the course of construction. And, could have been just a misunderstanding, could have been true. It was a VA deal, so maybe that's a VA. I've actually posed the question in another group I'm part of because I wasn't not heard that before. But almost always you have to make interest-only payments during the construction loan. And it's almost like a home equity line of credit. You're not, if you're borrowing $400,000, ultimately that's the full construction loan when it's all said and done. You're not paying interest on $400,000 from the get-go because the bank hasn't dispersed that. So every month the bank's going to say, okay, I dispersed $100 for the foundation, and now your balance is $100 on this loan, and we're going to charge you interest. You have to pay interest. Typically, you're paying your own taxes and insurance during the course of construction. Some lenders will have you pay your impound for taxes and insurance as well during that time, but most of the time you're responsible for that on your own during the course of construction. And insurance is another kind of interesting thing. Talk to your insurance agent and your builder, but you're going to have some overlap between your own insurance and the builder's insurance during the course of construction. Whereas if the fire burned the place down during the course of construction, who's responsible for that? Whose insurance is going to cover that? So just make sure you get clarity on those things. But yeah, typically you're going to have interest-only payments until you get to that final draw, and it rolls over to the permanent financing, and that is when you start making your full payments.
Great. As far as just figuring out who the best options are, how to just start taking steps on this. What are your recommendations as far as next steps if someone's ready to take this seriously? Obviously, if you're in Washington and Idaho, we're licensed there, so come work with us. But just in general, next steps to take it seriously.
Yeah, very, very important. Find an experienced construction lender, in your market. And your builder may have references for that. Now be a little wary of your builder, because your builders, this is not a character slur on any builders or the industry itself, but their motivations aren't fully aligned with yours, when it comes to construction loan, because builders are going to be more concerned about how the lender's draw process works. That's what they care about. Are they easy? Are they challenging? How does their builder approval work? Do I have to provide more or less documentation? And so they may refer you to a certain lender, but they're not necessarily going to be, the best price lender. And there's other great qualified lenders out there. Maybe they're already approved with this local community bank, and they don't want to have to go through. They know their process will be much simpler because they've already been approved with them, done deals with them, and they don't want to get approved with somebody else. But this is your long-term cost of money, and it could be substantially different. What was the question?
Next steps to take it seriously.
Yeah, so next step. So your builder could. So I wouldn't say not ask your builder, but like I said, go to find a mortgage broker. Mortgage brokers have great products. They're generally cheaper, and you're going to find very experienced people. You're going to find a lot of small entrepreneurial loan officers out there who want to hustle and do a great job for you. Go to mortgagematchup.com and specifically look for someone with a construction loan experience. Because you don't want to be somebody's first construction loan. Quick little anecdote, we can wrap up. Countrywide, some of you remember that name. They were kind of infamous in the crash. Bank of America ended up buying them out in the crash. But it used to be in our local market, another infamous name, Washington Mutual, was kind of owned the construction market. They did all the construction lending, and Countrywide wanted to get involved, and I brokered the loan to them. They were kind of one of their first construction loans. And we got to the closing, and it was kind of a bumpy process getting there, because it was really early in their process of saying, yeah, we want to be construction lenders too. We'll do that. And we got to the closing table, and the funder at the construction lender wanted to just hand over all the money to my borrower at closing. And I had to tell him, no, that's not the way it's worked. You can't just give them $300,000, at the closing table. This is a draw process. And the funder, I'm sure they would have figured it out at some point, but the funder kind of realized that. And, because what Countrywide did was they just said, they just took their regular people and said, now we're going to do some construction loans too. It's just another product, and it's really a unique animal. But find somebody who's got experience, who knows what they're doing, kind of knows what they're talking about, and, have a great project.
Cool. Sweet. Thanks, Ed.
Yeah.
Thanks for watching.
Thanks.